Hello everyone, and thanks for tuning in to the Financial Investor channel. My name is Brent, and today we're going to be discussing what is investing. So when you think of the term investing in your future, I've often seen many people automatically assume that I'm talking about their educational future, and they begin to talking about their careers or colleges that they want to apply to and go to, and their career overall. But investing has lost its true meaning, which is achieving a profit or material result by putting into financial shares, property, or other commercial options. So there are two basic types of investments that I'm going to be covering today, and all of these items within these investments all generate a profit. So the very first investments are ownership investments. So these are investments that you fully own or partially own. So these are your businesses. So this can be opening your very own YouTube account. It can be owning your own website, or opening up your own retail store, your online retail store, using Amazon affiliates. And these are all something you can control. You can create a product through or a service, and then you can sell it to people who want it. Entrepreneurs can make a huge profit this way, but the thing with entrepreneurship is that it can be one of the hardest investments to make it because it requires more than just money, but time. So it can offer the greatest return. Obviously, you see a lot of YouTubers out there that are making videos day after day after day, and they're putting out new content. They spend a lot of time researching, they spend a lot of time looking what their audience wants, and they're focusing on their business and generating and growing it. So next is real estate. This can include houses, apartments, and other rental properties. So you can buy these to rent or buy to repair and resell it as an investment. People often think of houses as investments, but unless that investment is paying you, it's not really an investment, it's a liability. So the house that you're currently living in is not an investment. It's fulfilling a basic need. And unless it grows in value over time, it should not be purchased with profit in mind. So right now in 2017, if you look on Zillow, you'll see that all the houses on the housing market are currently at their max value. So right now would not be a great time to purchase a house unless you're looking to be hit by the recession in the next year or two, and your market value for your house dropping a lot. So stocks is the third one that can offer you the greatest return. When you purchase a share of a stock, you own a portion of the company. If that company records profit, other investors are going to want more shares of that company, and the demand for the shares will increase the worth of the company and its price. Dividend stocks work the same way, only dividend stocks pay you a return, pay back a return to the shareholders, and this can grow over time, especially when you're reinvesting your dividend pay back into that company, which is going to increase the compounding, it's going to generate the compounding effect. And then we're going to get into the second type, which are lending investments. So these are investments that lend out, you lend out a percentage of your money in return for capital. So this one, savings bonds, is considered a lending investment. You're essentially lending your money to the bank in return for a very small. Oh, I have savings bonds. Oh, savings bonds. Man, okay, so these are safe investments you purchase for a set amount. So they have EE bonds and I bonds. EE bonds, they generate interest over time. I think the interest is locked in at the set price that you buy it. In I bonds, the interest rate increases with inflation. So I have EE bonds and I bonds, and I think it was EE bonds. Both of them normally 20 to 30 years, and they give you a specific set of amount in returns, and the returns vary. So depending on the year that you currently purchased it, that savings bond is going to offer you a different return. If you purchase a savings bond in January 2008, before the recession, your return was maybe 3 to 4%. If you purchased a savings bond after May of 2008, your return might be around 1.4%. I think those were what some of mine were. So certificates of deposit. Certificates of deposit used to be pretty decent. I remember back when Chase offered the Washington Mutual CD, which is a 5% return for a 12-month lock-in period. So again, you're lending your money to the bank for a specific percent back. This is often very low compared to the current average. The current average CD is 2.3%, which is what I read online, and the minimum balance required is around $2,000. So that is a gain of about $46. You're locking your money in for about a year or two, and if you need that money at any time, you can have some sort of penalty for early withdrawals. And the last one that a lot of people think is a very good investment and it's really safe is your savings account. This is considered the very bottom of the barrel in investments. You're essentially lending your money to the bank in exchange for a very safe but very low return investment. So a lot of the savings accounts out there offer a 0.01% return, and I don't think they even compound it. So if you have $10,000 in your savings account, you're going to get $1 back for that year. So that is terrible investment. If JP Morgan, they take that money that you lent them, they reinvest it in their company, and JP Morgan stock increased gigantic over the last year. So if you had just taken $5,000 of that 10 and bought 80 shares at $5,000, your return of investment would be almost $2,000 because of the increase overall for the year. Plus they pay, I think, a $2 dividend for every share that you own per year. They pay you $10. So if you had bought 80 shares and got paid $2 for every share, that's $160 in dividend pay plus the growth of the stock overall. So these secondary lending investments are not considered the best, but they are considered safe investments. So it's always nice to have a mixture. So don't have all of your money in one basket. So have a couple, portfolio of 70% stocks, maybe 20% savings bonds, while having at least a month or two, 3 to 6 months of cash in your savings account for those times when something happens. So that is it for this video. We covered what is investing, and we covered different types of investments. We covered the ownership investments and the lending investments. So that is it for this video. If you liked the video, remember to like, comment, and subscribe. If I missed anything or you want to have something talked about in the future, go ahead and leave that in the comments below. Remember to subscribe for future financial videos, and thanks for tuning in, and I will see you next time. Bye.